Fisher Investments on Asset Allocation and Time Horizon. Historically, stocks have had higher average returns than bonds over long time periods, but stocks' growth potential comes at a price: higher short-term volatility. Over periods of just a few years, stock returns tend to vary more than bonds. However, over longer time periods, stocks' return variability tends to fall below that of bonds. This chart demonstrates the impact of asset allocation and time horizon on portfolio volatility and returns. Standard deviation is a measure of volatility representing the degree of positive and negative fluctuations in the average annual performance return for the 5, 10, 15, 20, and 25-year rolling time periods since 1926. The line on the far left of the chart represents 25-year returns. The line on the far right represents 5-year returns. Notice that volatility, measured on the x-axis, increases over shorter time periods. Also notice that the average annual rate of return, represented on the y-axis, is generally higher for equity-weighted portfolios compared to bond-weighted portfolios. However, the volatility, or standard deviation, decreases over longer time periods. This chart illustrates this effect in hypothetical portfolios with different allocations to stocks and bonds measured over a 5-year rolling period. Historically, over 5-year time horizons, portfolios with heavy stock allocations have higher growth potential, illustrated by the green bars, but they also have higher return variability or standard deviation, illustrated by the yellow bars. This chart demonstrates this same effect over a 30-year rolling period. As you can see, over longer time horizons, portfolios weighted towards stocks have tended to maintain both higher average returns and lower return volatility than portfolios with more bond exposure. Based on our analysis, Fisher Investments believes that asset allocation and time horizon are the primary drivers of the volatility and return trade-offs within portfolios. However, time horizon alone cannot determine the optimal portfolio for a particular individual. The suitability of specific asset allocations is equally dependent on an individual's investment objectives and financial profile.